Hello everyone, and welcome to Next Vault. Today, we're discussing a crucial topic for all investors. Why do people panic in the stock market? This question often arises during periods of high market volatility. Understanding why anxiety takes over and how to avoid giving in to panic can not only help you better manage your investments but also improve your long-term investment approach. Let's delve into the reasons behind this panic and how to address it effectively. 1. Leverage and fear of loss. One of the main reasons investors panic is the fear of loss. This fear can be overwhelming, especially when leverage is involved. Leverage amplifies both gains and losses, making every market movement much more stressful. Why is this important? Fear of losing money can cause an investor to sell hastily, often at the worst possible moment, compounding their losses. The greater the leverage, the higher the risk of panic when prices drop sharply. How to avoid it? Use leverage cautiously. Don't take overly risky positions if you're not prepared to absorb substantial losses. Stay calm during downturns. Take a step back and evaluate the situation objectively. Panicked selling is rarely the best solution. Have a risk management strategy. Set loss thresholds in advance and stick to them, rather than reacting impulsively. 2. Market volatility and uncertainty. Market volatility is another major driver of panic. Stock markets can experience rapid and dramatic swings, creating uncertainty. When prices drop quickly, many investors succumb to worry and, fearing further losses, sell off their positions in haste. Why is this important? Volatility is normal in the stock market, but when it's exceptionally high, it can create an atmosphere of uncertainty that leads to overreactions. This often triggers a spiral of sell-offs, exacerbating market declines. How to avoid it? Understand volatility. Accept that volatility is a natural part of investing. Don't let daily fluctuations dictate your decisions. Focus on the long term. While short-term declines can be unsettling, markets generally recover over time. Consider hedging strategies. For experienced investors, tools like options or short positions can help protect against excessive volatility. 3. Herd mentality and group behavior. Herd behavior is another phenomenon that contributes to stock market panic. When prices start falling, many investors follow the crowd without thinking critically. This fear-driven sell-off amplifies market drops, creating a feedback loop. Why is this important? Collective panic can cause irrational price declines. When everyone sells simultaneously, it creates a domino effect that intensifies the downturn. How to avoid it? Stay objective. Don't be influenced by the actions of others. Make decisions based on your own analyses and financial goals. Diversify your portfolio. Diversification reduces the impact of widespread panic. If one segment of your portfolio declines, other assets can help offset the losses. Stick to your plan. If you've defined your investment strategy, trust it, even when market news and emotions run high. 4. Media influence and negative news. The media and negative news play a critical role in spreading panic. When a financial crisis, recession, or geopolitical issue arises, the information is often dramatized, triggering ripple effects in the markets. Why is this important? Media outlets have a huge influence on public perception, often magnifying the sense of crisis even when economic fundamentals remain sound. This leads to emotional reactions from investors. How to avoid it? Don't get carried away by headlines. Take time to analyze information instead of reacting impulsively to alarming news. Seek reliable information. Avoid sensationalism and turn to reputable financial sources for a clearer picture of the situation. Maintain a long-term perspective. Crises are often temporary. With a long-term strategy in place, periods of volatility become less concerning. 5. Unrealized losses and psychological impact. Unrealized losses can also have a significant psychological impact. Even if a loss hasn't been realized, e.g., by selling, simply seeing your portfolio decrease in value can cause anxiety. This fear may push some investors to sell their assets, even if a rebound is likely. Why is this important? Unrealized losses test an investor's emotional resilience. They can lead to irrational decisions, such as panic selling to avoid the appearance of loss. How to avoid it? Accept fluctuations. Unrealized losses are a normal part of investing. View them as temporary and focus on long-term growth. Reassess your portfolio calmly. Avoid rushing to sell. If the fundamentals haven't changed, holding steady may be the better choice. Stay focused on long-term goals. Managing unrealized losses becomes easier when you concentrate on your portfolio's overall long-term performance. Conclusion: stock market panic is often irrational and can lead to hasty decisions that harm your finances. Understanding the causes of panic, like fear of loss, leverage, media influence, and herd behavior, can help you better manage your emotions and avoid costly mistakes. Thank you for watching this video. If you'd like to learn more about managing emotions in the stock market and making smarter investment decisions, don't forget to subscribe to Next Vault for more tips and analyses. See you soon on.